Let's, take a handle on what is the reasoning behind this. Prateek Parekh of Nuvama Group joins in to talk about all of this and, of course, the market fundamentals as well. Hi, Prateek. Thanks very much for joining in. It is said the first one through the wall gets a bloody nose. So are you prepared? Let's start with the call on the BFSI sector first.
Yeah. Hello. Good morning. Thanks for having me over. So yes, I guess we are one of the early ones to take the call on financials. So I'll just briefly tell about our view on markets. So today, if you look at the overall backdrop, it is a very challenging one, especially on the global front. Global PMI has moved into contraction, which is clearly indicates weak earnings or recessionary outlook. This is the fourth time where global PMI has gone into contraction, but what is very unique this time compared to what we have had in the past is that the rates are going higher. So from a global equity markets perspective, it is worst of both worlds, where you have earnings growth slowing down and rates going higher, squeezing valuations. This, as a result, is going to surely or is leading to volatility in Indian markets as well. And going ahead, we think that the global spillovers will actually broaden. Now, if you look at the global markets and the overall global economy, it has very large spillovers to Indian equities for sure. The spillovers come not just in terms of flows, but more importantly in terms of earnings as well. If you look at, for example, last 3 years, real GDP CAGR of India is just 2%, but Nifty earnings CAGR has been 20%. And a large part of this very strong earnings growth can be attributable to the global reflation, which flows to India in the form of prices, liquidity, as well as on the form of exports. When we look at the market internals, so far where what markets have priced in is the whole prices pain point, where we have seen metal stocks and also the energy stocks cooling off and underperforming the headline indices. Markets to a reasonable extent have also priced in the concern on the export front, where IT has been one of the biggest underperforming sectors this year. Where we think that the next pricing is likely to happen is on the liquidity front. And this is the main reason for our downgrade of financials. Now, if one looks at financials over here, they have overall for financial space has had a very good last 2 3 years. Last 2 3 years, despite the whole pain in the real economy, financials balance sheets have improved significantly. Uh, they have delivered the best earnings in a weak economy, and the large reason for that is a very strong liquidity environment. But what is changing now is that the liquidity surplus, which was at 8 trillion INR 6 months ago, has now largely vanished. And if you look at the rate transmission cycle in India, when RBI raises repo rates, the first segment where the rates get transmitted is actually on the lending front, which we have seen that happening, and across the board, lending rates have gone up because a lot of loans are linked to repo rate directly. The next space where transmission happens is on the money markets. The short-end rates, CPCD rates, there as well, the spreads have widened significantly. Where what we foresee going ahead is the transmission of rates from lending and money markets to now deposit rates. And here there's a lot of catch up left to do. If you look at the weighted average deposit rate of the banking system, is roughly 100 to 150 basis points lower than what you get at a government GSEC yield. So to that extent, if rates remain tight for longer, I think incrementally from here on, transmission will be more on the deposit rates front rather than necessarily on the lending rates front. Question that we need to ask ourselves is that if deposit rates go higher, can banks again raise lending rates to maintain their higher margins, or will it lead to growth slowdown or other concerns? And here is where we differ from the street, and where we believe that while deposit rates will go higher, the ability to absorb rates on the lending front remains relatively muted. Households, the income outlook is not very great, especially with the fact that on the IT as well, the hiring, which has been the mainstay of hiring, is slowing down. MSME balance sheets are just getting repaired, and they're coming out of a big pain point that they had during COVID. And on the corporate front, while their balance sheets are very clean, they're very much delivered. But I think if global reflation goes away and prices tailwind is not there, their credit needs also will be lower, not only on the working capital front, but the around capex as well. Some of it can get potentially pushed out. And that's why we believe that on the financials front, where currently the scenario is very much blue sky, where margins are very good. You have no asset quality problems and credit growth is at a 9-year high. We do see some, hiccups coming up, which is in the form of, liquidity tightening, which will potentially peak out margins and also weigh on growth going ahead.
Okay.
Although I must say that we don't foresee any asset quality issues as of now.
Okay, so no asset quality issues, but do you see growth slipping for the banking sector compared to at least the consensus expectation? Can we talk a bit, Prateek, about the EPS expectations? Because currently the street is pricing in some solid EPS growth numbers for the next 2 years. Now, you've done some analysis. In the past crisis, in GFC, the EPS downgrades were about 25%. More recently, in the 2018 tightening, the EPS downgrades for the Indian economy or the Nifty was close to about 17%. But up until now, we've only seen about a 3% earnings downgrade. What's the extent of earnings downgrade? Do you see this picking up to double digits? And what would be the earnings forecast, according to you?
Yeah. So if you look at the whole consensus earnings forecast, right now the street is forecasting 15% CAGR from FY22 to FY24. We potentially see this as at risk, and our simple reason is that if global reflation is going to go away, then our earnings outlook will moderate. Nifty earnings, contrary to popular perception, are very strongly correlated with commodity prices. In fact, if commodity prices go higher, it actually helps improve the aggregate Nifty earnings, and also are very heavily correlated with global growth. And if that is going to moderate, I think the earnings downgrade momentum, which right now is very much concentrated in commodities, will potentially broaden out. And in our view, we think another 10% earnings cut can potentially happen over the next 3-4 quarters per se, is what I would say.